Now, we always like to briefly begin with showcasing some of our recently posted content available on YouTube and sometimes also available on the webinars page in Power Options. Brian had 3 quick questions last week related to the portfolio tool. Is now the time for bull put credit spreads? And a third topic that he had on there as well, I believe, related to time decay. And then there were 3 other quick topics we covered: use married calls, analysis on a position, and some other discussion that was available as well. A couple weeks ago, we had a talk on expectancy, and we followed that up using a historical search. And we had a discussion on short strangle positions, where someone who had entered a short strangle, we used the Amazon example, was underwater, and we were looking at ways of when to manage and things of that nature. And then we talked about a discussion on buying strangle positions out of the money strangles as well. And then most recently, 2 weeks ago, we had a good discussion on comparing stock hedge strategies. You can check that out at YouTube at any time. And as I mentioned, for those of you just getting started off with new strategies, and we're going to start off with a quick question related to that as well, check out the playlist while you're there also. We've designed a variety of playlists and basic strategies designed to introduce the strategy, criteria, discussion, and tools, comparisons of different structures and other strategies within the strategies, how to manage a winning trade, and how to manage losing trades, most importantly, as well. So if you're interested in getting into spreads, starting off in poor man's covered calls, you want to start off on the playlist there to get some good basic and insightful education as well into the strategies from introduction to management. Now, that being said, I had a quick email question that was sent to me. It was around 4 p.m. Didn't have a chance to get a lot of slides together, but it was mostly just discussion. And the question came in. I have 2 questions. Historically, what has been your best strategy? And what's the average quarterly return of the strategy? Now, my response, of course, as you've heard me say many times before, every market condition is different. And no one strategy will be profitable in every market condition. I know most of you know that. What worked for you well in 2017, first half of 2018, didn't probably work the same in the first half of 2022, for example. Now, in 2015, we started to develop various trading approaches using our patented search tool. Ernie developed the monthly and weekly picks of the day for covered calls and for the naked put strategies as well. When you go to Power Options, you can see those links under the Covered Call tab or under the Naked Put tab, respectively. Now, if you click those direct links, you can see how we develop these results. Now, for example, during the 3-year testing period for the monthly covered calls, the total return was about 59%, which came out to about 19% per year. So we're looking at, just under 4%, 5% per quarter, roughly. Okay. And that's what one might expect within the money covered calls, which is what we're doing, offering more protection, taking a smaller return than, say, out of the money covered calls. If you're in a raging bull market, you're trying to look for maybe 1.5% return per month in some cases, maybe a little bit more in a good bull market. Now, the weekly covered calls were higher, 24, 25% over the tested 1-year period, I think from 2015 to 2016. So around 6% per quarter. Now, during that same time, about 2016 to 2017, I was fine-tuning the bull put credit spread approach, which many of you have heard about, various webinars during that time. The criteria we prefer is the weekly bull puts and the default bull put credit spreads. Starting off with a $100,000 account, the portfolio grew to $116,841, about 16.8% in 2019. That seems pretty low, doesn't it? But remember, this is a leveraged position where you can quickly realize a 100% loss in an adverse market to a bull put or to a bear call even. And that's why we only allocated 15% of the total portfolio, $15,000. And the profit was $16,000 on $15,000 invested, so it was about 112% return total for 2019, with some quarters showing as high as a 30 to 35% return. However, we didn't do this. Those of you that have been joining our webinars, I've only traded 7 bull puts during 2000. Actually, it's 9 now, bull puts during 2022, and I had to manage 3 of them. Thankfully, I used a pendulum adjustment to manage 2 of them for a profit. The other one was a small loss. So it was still profitable, but it was hard to do. If I had just taken the same approach taking the top 3 trades, allocating $15,000 to bull put credit spreads, even with a higher probability, the portfolio would have bent down around 85%. That's the risk with the spreads, because you see wild swings. That's why you need to only use it with a smaller portion of your portfolio. This was based on the latest test we did for one of the other webinars, and I think that was on June 25th, if I'm not mistaken. It ended January 3rd to June 25th, if I'm not mistaken. And following up, of course, as you all know, many investors have had to change their strategies based on the uncertain market conditions in 2022. In the beginning of the year, we started discussing approaches for bear put debit spreads, calendar put spreads over more bullish strategies. And of course, due to the volatile markets, these were initially profitable, but the wild swings kept them from being as profitable as some of the other strategies mentioned above in more consistent markets. We had some different moves up and down, as you all know. So you had to change pattern. You had to manage it. You maybe had to back off of those and go into another strategy. That's what it was. I will say through February, though, the leverage return on bear put debits was probably close to some of the higher return periods we saw with the bull puts during the markets that favored bull put credit spreads. And as everyone knows, at any given time in any market, we will have, Ernie and myself, will have married puts open following the guidelines in the blueprint. Now, this doesn't mean this position is going to be profitable in a bearish market, but I have a controlled risk of only 4, 5, or 6% on the trade. And the put is actually a second vehicle that we can adjust. The blueprint discusses 12 different income methods, everything from selling a call to doing different management with the puts, using spreads inside the married put construct, and so forth. So the idea is those income methods can help us to reduce the cost, even if the stock is down, to prepare for a rally, to get a lower break even. We can also generate income just as you would in a regular stock position or in a poor man's covered call. So that was my response. And as many of you know, you've seen the same responses discussed before. But this gives us a good opportunity here to just go ahead and ask you, historically, what has been your best strategy? Now, I couldn't put every strategy in here, but your best strategy over time, is it covered calls and naked puts, and sometimes you drift out in the spreads, you drift out in diagonal spreads, but you come back more often? Have credit spreads, debit spreads, I'll even include iron condors in there, been your best strategy? Buying calls or puts, which honestly, I've never been truly successful just picking calls and puts. I've had some good luck with buying calls on the VIX during volatile markets as a hedge. Recently, we tried the earnings plays on buying calls on oil ETFs and things of that nature last quarter, and buying puts on XRT, the retail ETF. And we'll include buying straddles or buying strangles in there as well. The poor man's covered call or calendar spreads, or have you been selling straddles or selling strangles? Selling a naked call and a naked put either at the same strike price or out of the money. All right, so we've had this poll open for about a minute. 65% of you voted. A little bit different than what I thought I'd see, but that's perfectly fine. Let's go ahead and share the results real quick. 46% of you say covered calls and naked puts, out of the money cash secured puts, have been your best historical strategy. 31% say credit spreads and debit spreads. I'm probably going to go into that category as well, with the caveat that during the right markets, as you all know, we've heard me talk about forever, the bull put credit spreads had the highest return of a strategy I consistently used in my portfolio. But when it's not time to use them, it is absolutely not time to use them. You can switch to the debit spreads, which I did in that case. So I might be lumped into that group too, but it's only with that smaller portion of my portfolio. Buying calls or buying puts, 8%, or possibly straddles and strangles, and 15% poor man's covered calls, diagonal calendar spreads. Okay, so good, consistent answers here. No one was selling short straddles or short strangles. We did have discussions on those recently. Now let's go ahead and follow that up. I'm just curious, and you don't have to answer this if you don't want to. Regardless of which strategy you answered, what was your best annual return on the investment in your favorite strategy? Was it greater than 50%? Was it 40 to 50%, 30 to 40%, 20 to 30%, or 10 to 20%? And this is shaping up exactly, a little bit. Okay, it's shaping up near exactly as I thought. And that's fantastic. All right, so 76% of you have voted, and we've had the poll open for about 30 seconds there. Yes, I wanted to put an under 10% in there, but they only give me 5 answers here, so I couldn't continue that on. Let's close and share the results. The winner here is as I expected. 54% said 10 to 20%, which makes sense to me with the larger portion of the audience trading covered calls and naked puts. Just like we mentioned, that's sort of the target you're looking for, that 1 to 1.5% per month with out of the money naked puts or in the money covered calls for protection. And sometimes if you're using at the money or out of the money covered calls in a strong bull market, you'll be able to do maybe 25. We've got 15% saying 20 to 30%, and that's fantastic as well. That's great. That's amazing. Doesn't mean consistent, but again, right strategy, right market conditions, you can have a fantastic year with the various strategies. 8% said 30 to 40%, and 8% also said 40 to 50% of an annual return for a given strategy. And 15% said greater than 50%. I think barely, it's more than that, but yeah, I think I'm in the greater than 50%. And again, that was during the good year of 2017 and 2019 with the bull put credit spreads again, which only represented 10 to 15% of my portfolio. But the returns one year was about 84, and the returns the other year was about 52. So that's it. But again, that's with the smaller portion. The annual return with the larger portion of the portfolio into maybe safer positions such as married puts, collars, even covered calls perhaps, that is down into this 10 and 20% range for the bulk of the portfolio, 50 to 60%. But just wanted to clarify that. Let's go ahead and hide those. And yep, we're back there. So just wanted to cover that. I thank you all for including your details and sharing with me your information regarding what strategies you prefer, and if historically been the best for you and what your returns were. That's great. So that'll help out AC, who sent the email as well.